Hello, and in this video I'd like to go through problem 5.1a, which is a problem we've done in class, and on basic merchandising transactions. This problem also illustrates some of the basic questions we dealt with on discounts and how to recognize them in sales transactions. So the very first line of the problem, it says record, and the problem is actually entitled purchase-related transactions using perpetual inventory system. We haven't really discussed yet what the perpetual versus periodic inventory system is, but I'm going to start by simply saying that the perpetual inventory system is a system where cost of sales transactions are recorded simultaneously with the sales transactions for our purposes. Perpetual and periodic inventory system, unlike perpetual system, we'll learn that later, records a cost of sales transactions in the end of the period on the basis of the final inventory count. But so for that kind of is less relevant to us right now, but I wanted to first and foremost clarify the term. The very first transactions on October 1st purchased merchandise from UK imports for 14,448, terms FOB destination net 30. Again, and here it doesn't say purchased on account, but it's implied because there's a net 30 element to it, essentially, that basically says that there is no discount, but you are paying within 30 days. We would record it as an account payable because essentially we assume that whenever anybody is given an extended terms of purchase and there is no discount for early payment, they'll take advantage of it. So it's kind of an implied transaction that this was indeed paid on account. FOB destination again implies that the title passes to the goods purchased upon receipt, upon actually delivery. And so while the goods are in transit, they actually belong to the seller, not to the buyer. But the journal entry for the first one is pretty straightforward. You debit inventory for 14,448. And you created accounts payable for 14,448. So that's October. That will be our first transaction. Second transaction, October 3rd, purchased merchandise from Hoagie, 99.50, terms FOB shipping points, 210 net end of the month. Prepaid freight was added to the invoice. So now we actually again here there's merchandise being purchased with the discount. Again, the terms of the discount are that you pay 2%, you get 2% discount if you pay within 10 days. Otherwise, you pay net in the end of the month, which would be here by October 31st. So again, we assume it's purchased on account because any company would want to take advantage of the discount, it's sort of trade credit terms. There is no advantage of paying right away if you're given an opportunity to pay with a delay. So I mentioned that the true price of the transaction is net of the discount, right? Because essentially discount is always simply a finance charge. So if you calculated what the net cost of this is, with the discount, that's 98% of 99.50, or 97.51. But then also there is a prepaid freight. Now here the delivery is free on board FOB shipping point, meaning the title passes when leaving seller's shipping dock and the inventory belongs to the buyer while in transit. We talked about capitalization principle and the idea that cost of freight in, because it's an expenditure required to make inventory available, need to be added to the inventory cost. So we need to take 97.51, which is the 98% of 99.50, and add that to the 220, and that gives us 99.71 as the total capitalizable cost of inventory. So on October 3rd, we're going to record debit inventory 9971, credit AP again 9971. So that's those first two transactions. The transaction on October 4th says that purchased merchandise from TAC of 13,650, terms FOB destination 210 net 30. Again, we're taking advantage of the discount. We're going to record the inventory purchase net of the discount. So what is it? You need to take 98% of 13,650. And that's 13,377. So again, I'm going to simply debit inventory here, 13,377, credit accounts payable, 13,377. That's for October 4th. October 6th issued a debit memo for 4450 of merchandise returned from purchase on October 4th. So a debit memo is simply a purchase return. So you need to take the inventory, because you're returning it, off your books and debit accounts payable. On October 4th, remember that this we recorded is 4550 or 13650, but we recorded it net of the discount. So you need to record 98% of 4550, which is going to be 4459. So there's 98% of 4550, 4459. So you in this particular case debiting accounts payable for the return of 4459 and the credit inventory for 44,459. On October 13th, it basically says paid Hauge for invoice on October 3rd. On October 3rd, remember this was the purchased inventory for 9950 and 210 net end of the month. So we recorded that with discount. We included $220 worth of freight. This was this transaction right here. We recorded altogether 9971. The key here is to just check whether, in fact, you took advantage of the discount. You are paying within exactly 10 days. So 3rd to the 13th is 10 days. So so you don't have any finance charges. So you simply need to, in this particular case, you're going to be debiting accounts payable for 9971. And crediting cash for that amount, 9971. And so that was October 13th transaction. All right. On 14th, paid tackle for the invoice, last debit memo on October 6th. Again, remember, if we go back, on October 6th, the transaction was, on October 4th, the transaction was purchase of, in this case, 13,650, FOB destination 210 net 30. This was this transaction. And then we debited part of it out, 4459. So right now we're simply paying the remainder of what's remained on accounts payable, which is the difference between 13,377 and 4459. It's still, I believe, within very much within discount terms, right? We originally bought it on the 4th. We're paying in the 14th, so there is no additional charge or anything like that. So it's simply just paying the difference, which is 89.18 in this particular case. So so that transaction is simply going to be a debit to accounts payable of 89.18 and credit cash of 89.18. That's on the 14th. And then on the 19th, purchase merchandise from Veggie Company of 27,300, terms FOB shipping point and net end of the month. Again, there is no discounts here. There's nothing about the freight. So this is just FOB shipping point, meaning that they acquire the title after it leaves seller's dock and transit, it belongs to them. So it simply is the debit to inventory, credit to cash, to accounts payable for this amount. Sorry about that. It's kind of a camera getting a little odd and loose. My apologies for this defaulting periodically here. All right, so that's kind of how you account for this transaction. All right. Paid freight of 400 on October 19th, purchase of Veggie Company. Remember, on October 19th, this was the transaction for this one right here that we just recorded, 27,300. Again, the freight thing is simply it's an expenditure necessary to put this inventory in the operation. It's freight in. So we simply need to add it to inventory. So we would be, in fact, simply just debiting inventory, additional $400, and paying cash, in this case, for $400. So that's on the 19th as well. All right. Purchase merchandise from Caesar Company, 22,000, terms FOB destination 110 net 30. Again, discount 1% of paid within 10 days. So take 99% of the purchase price. That's the true cost. Or 21,780 debit inventory. 21,780 credit AP. 21,780. This was a transaction on the 20th. On the 30th, paid Caesar Company for invoice on October 20th. Again, they're taking advantage of the discount because it's within 10 days. So simply debit AP 21,780, credit cash 21,780. 31st, paid UK imports for invoice on October 1st. In this particular case, there was no discount. This is this very first transaction, which we recognized right here. This is what we had before, 14,448. So there was no discount taken or even available. So that simply is, the debit in AP 14,448, credit in cash 14,448. If even, like I mentioned in class, even if there was a discount available, say 1%, in this particular case they took till the end of the month to pay it, and discount, let's say, was only available first 10 days, Any difference between the original accounts payable and the actual amount paid, which would be in this case higher by that 1% forfeited discount, would need to be recognized in as a finance charge, as essentially kind of an interest cost of sorts. And finally, the last transaction we have on the 31st is paid Veggie Company for invoice on October 19th. Again, there was no discount taken, so it simply is just the reversal of the original AP, so accounts payable 27,300, cash credit 27,300. So debit accounts payable, credit cash, the same amount. So that's basically kind of how you account for journal entries with discounts, and pretty straightforward kind of question. Thank you.